He's angry about mortgages. It's Angry Mortgage. He's swearing. He's cursing loud. He's old. He's opinionated. And he's been doing this so damn long. This program is about mortgages, and this is mortgage advice, but the advice may not apply to your situation. Contact licensed mortgage professionals for specific recommendations before you make decisions about mortgages. You may not agree with Ron, but if you don't, he thinks you're wrong. Oh, and did we say there is a lot of swearing?
Welcome back.
We are back.
Angry Mortgage. And we're angry.
Angrier.
Even if I'm smiling. I will be angry. I guarantee you. By the end of the pod, we'll be angry. I assure you. Okay. All right. This week in the news. Something from the Bank of Canada. Bank of Canada decided to roll out some data, a study, an idea, possibly bullshit, that the people will struggle in the big renewal years of 2025 and 26. Because housing activity just isn't uniform, right? There's some slow years. You notice that in the real estate business.
It's up and down.
There's slow years
and
there's busy years. Now, it's even more extreme in the mortgage business because some years the rates are great and people are jumping all over them. And I'll take an early renewal. I'll do a refinance. I'm buying a house because the rates are great.
Yeah, need a kitchen. That's
whatever, all that stuff. Okay. Yeah. And so some mortgage years are much bigger than others. Kind of runs in a 5-year cycle. So if 2020 was a busy year, obviously set aside 2 months of COVID, crazy town.
Yeah.
Okay. I always found it interesting. In COVID, they said everything was shut down except real estate and real estate financing. Yeah.
I thought I was unemployed and bankrupt at that point. And I'm like, oh my God, we can't go see houses.
And
what
all
the
of a
hell
sudden,
are we going to do?
All of a sudden, Rob Ford announces this is a exempt service.
Yeah.
Like it's groceries, healthcare,
and you can buy a house. You can't hang out with your friends, but you can go see a complete stranger's dwelling. Walk through their house.
Seriously, exempt industries.
Yeah.
Dry cleaning and real estate, and then eating and sleeping and healthcare and everything else is shut. Like we shut the car factories, shut the stores. Can't go to a store. One person can't even go into the store. But if you want to go to an open house, fill your boots.
No, we couldn't have open houses. Those were
but you could in about the no open houses only lasted about 2 months.
Yeah, but it was a thing. It was private showings only.
Private showings only,
and you just click off a little. Well,
that was sort of my version of an open house. Yeah. It wasn't like everybody's not 20 people wandering around the house, but as long as you only came in with your masks on, one session, one group at a time. It was allowed. Yeah. That was it. So
the best part of COVID, just mentioning the stores, was say Walmart. You could walk into Walmart and buy apples, but then they'd have the clothing blocked off. You just couldn't go.
Did you actually reach across the aisle?
No, they wouldn't even let you check out because I tried. I think it was like a pool toy or something. I'm like, what's the difference? I'm already at the store. Anyways, that was just a rough time for humanity in general. So
that was tough, but interesting. I find this fascinating.
Yeah.
Nothing stops real estate in Canada.
If anything, it spurred it on.
And it did. So to get back to my point, 2020, despite, 6 weeks of COVID total shutdown, people scared. The real estate market came right back. Like by June, it was hot as a pistol. And mortgage market came back because rates went to zero. Rates went to zero.
Free money.
The variable rate was it's 0.89. What do you think? What?
I'll take it.
I'll take it. It's less than 1%. I'll take it.
And I will buy 4 houses.
and 5-year fixed was 1.59 for 5-year fixed.
I'll take it.
Inflation rate's 2%. Yeah. So back then, inflation was 2%. So interest rate less than inflation equal you're paying me. Essentially, you're essentially paying me.
3-year? Do you recall?
Well, we
COVID?
never sold any 3-year.
No, there was no 3-year.
3-year is only something that's happened in 2020, late 2022.
Where it started to get popular. Yeah.
It's only now. It was
Okay.
never ever, no 3 years. Who knows? We didn't know what that price was. We had no idea. So yeah, it was crazy busy then. Crazy busy in the record mortgage year in the history of Canada. Mm-hmm. All the banks, all the credit unions, every mortgage broker. 2021, the record year of all time. May never be surpassed. I don't know, but it was the record. And those 2 years, 2020 and 2021, will come up for renewal in 2025 and 2026. So the Bank of Canada says, okay, we got a problem. We think that the rates are going to be quite a bit higher, and that's going to be a big stressor on Canada. We don't know. It's going to be bad. Rates could be 40%. For some of the variable people, we think the rates could be 40. Rates would be much higher, and payments, most importantly, payments will be 40% higher for some people.
Yeah. Does that not sound accurate to you? It sounds pretty accurate to me.
It's actually total bullshit. Okay?
Really?
Let me explain why.
Okay.
First of all, by the time we get to 2025, we don't know what the rates will be. Who the hell knows what the rates will be? Now, they're probably not going to be 0.89 or 1.59 again. That's for goddamn sure.
They're going to be higher, than what they were.
But they might be a rate that starts with a 3, maybe a low 4. We don't know. And another interesting point, which I've never really brought up before in any of my social media work, is that when you've got a 1.59 fixed rate for 5 years, you have paid down a shit ton of principal. Like a ton. Yeah. Like a lot. Okay. This isn't like variable that went straight up after 9 months. Okay? Or a year.
So you're saying mortgage balances.
Mortgage balance goes down, way down. So and let me give you a couple of other interesting stats. Theoretically, 18% of all of those houses were sold. Like there's no mortgage on them anymore. They belong to other people. Yeah. There's just if over the course of 5 years, there's a certain amount of sales activity with those 1.59 rates, with those old rates.
They've moved on already.
They're gone. The mortgage doesn't exist anymore. Yeah. Okay. And we definitely don't know what those future rates will be. And we don't know. Here's the next thing we don't know. What if when we get there, so a 25-year turns into a 20-year, right? That's how amortization works. Sure. Right? Your contract says you have 25-year amortization. Unless you've got a variable, then you might have 92 years, but we'll touch on that. We touched on that last week. That was last week. Yeah. Okay. Now, what's going to happen is that let's say you started at 25-year amortization. You're on a fixed rate. You're now on a low fixed rate, you paid accelerated biweekly, and Jiminy Crickets, you're like got a much lower balance, and it's not like half, but it's lower for sure. Yeah. And you now have to have a 20-year cycle. You paid for 5, a 25-year am. Now it's
down to 20.
It might be 18 because you paid accelerated. Yes. So and again, you were paying off a ton of principal. So what if you say, well, yeah, these payments are up, but why don't we switch to 30-year? Can we do that, Mr. Banker, do you think we can switch to 30-year? I'm down to 20. Right. Can we switch to 30? Sure. If you qualify, you may not qualify, but you may qualify. So you could rewrite that back up to 30-year am. You could rewrite, if you started at 30, went down to 25, you could rewrite it back up to 30 if you wished. If you qualified, you have to apply. You have to find out. All I'm saying is you could drive a truck through the holes in this study. So like this see the Bank of Canada study is just
theory, but there's also, like you said, other variables.
The theory is possible. That could I don't know what. I don't even bother reading it. It seems so stupid. Okay, so because here's what I know from nearly 29 years doing this. You can't predict rates. It's stupid. Okay, it's just dumb. By the way, again, friend of the show, Steve Swarovski said, you guys couldn't even figure out whether inflation was temporary or not. Or, you guys told us for a long time. We were like 6 months. You said no, transitory. No inflation. You said don't look behind the curtain at inflation. Okay,
what's that movie? Don't Look Up.
Don't look up. Don't look up. Meteor's coming. Look, it's just transitory. Nothing to worry about. Well, that was bullshit. Okay, so but I also have this long time experience, and this is what I know. Rates or not. Don't guess 3-year rates 3 years out. That's stupid.
Yeah.
Okay. Don't guess people's situation 3 years. I didn't even bother to talk about the fact that after 5 years, one of them might have got one of the people in the couple might have got a much better paying job. Yeah. And the other one might have got a couple of raises. Okay. We don't know.
Yeah.
Like the idea of saying it's going to be a dire predicament in 3 years is just dumb. That's dumb. Okay. And I'll touch on a few other things. This leads everyone to think that, oh, well, we probably have a bunch of people experiencing trouble now because, some of these variable rates, they went up, right? Like they
significantly.
Payments went up. Hey, Scotia just announced their numbers just this week. And they specifically were asked about their variable rate mortgage scenario, where those payments went up every single time. Yikes. Every single time.
So there was no cap.
No cap. No phony trigger point bullshit. No, your amortization is 92 years. None of that with Scotia. Scotia's spot on.
Really?
Okay, yeah. I knew the guy who sort of made sure that happened too. It was a friend of mine back in the day. He's retired since, Jim Smith, brilliant guy. And he says, I made sure that we set the product up that way when other people were going the opposite direction. We went this way. So, and it was also, Jimmy was really smart too. So it saves you a little bit on the capital side, saves you a little bit to have that product in place. And it's better for consumers. So at the end of the day, here's Scotia's announcement. Yeah, we have no impairment on those loans. All those payments that have gone up 45%, 50%, we have no impairment. They're no different than the rest of our portfolio. That variable rate stuff doesn't look any different than our fixed rate stuff. Yeah. Looks the same in terms of default, delinquency, not paying, trouble paying, anything like that. So, and they're not giving any deferrals either. Like there's no, potentially a small number of people might have asked for extended amortization, which is available, has been approved by OSFI, but the bank regulator, but no, there's no indication. Which brings me to something that's I think is really important that I'm going to say this probably another 10 times over the course of the next 6 months. If and again, I have just seen this. I am old. I am decrepit. Okay. I might not look, sometimes people say, you don't look that old. Yeah, because I'm so fat. Okay. And when you're so fat, it just squeezes the wrinkles. You don't see wrinkles. If I lost like 180 pounds, I would look like death warmed over. Okay. I mean, it'd just be wrinkle city and sagging everything. And, I might lose the triple chins, but I would look bad. And sometimes I feel bad. But this is the truth over all of my career in the mortgage business. And it's certainly been proved this year that increased payments do not create defaults. Payments go up, payments go down, and payments go a lot up, a ton up like we've experienced. Not much default. Now, no default. Like today, the default rate at these banks is it might have gone up to 17 beeps from 15. And by the way, historically, it's been 35. Like if you go back 10 years ago and your bank had 32 beeps default, 30. Everybody know what I'm talking about when I say beeps? A beep is 1/100%.
Yes.
1/100%.
I know, but we forget that other people, normal people, don't know.
I'll be like my friend Rob McClister, who puts it in brackets after everything he ever writes. A beep is 1/100%. So that's what it is. And he's a good guy. He's smart to do it. So we run default rate, a 90-day default rate, default rate, because you could miss one payment and you could just be out of the country. Something go wrong.
They're not knocking. The sheriff isn't knocking on your door after one payment.
But also it's meaningless. Like, probably the richest guy in Canada misses a payment sometime. It's just something just goes awry amok. So, but it's 90 days is a serious default. It's recognized by our banking system. And those are at 17, 16, 15 bips, 15 beeps.
Really? So not even...
Which in 10 years ago, the average was between 32 and 35 bips.
Wow.
And nobody thought that was dangerous even then. By the way, U.S. bankers would come to Canada where it runs about 58 bips, okay, and say, oh, God, you guys are really cautious underwriters. I mean, if we're not running 58 bips, we ain't lending. If we're not running 58 bips default, we're not. If our people aren't at least in that, our borrowers are at least not at 58 bips in arrears, doing bad, not making payments, we haven't done our job. We didn't lend enough money. Oh. Okay. So the Americans always looked at the Canadian default rate and said, Jesus, you guys are tough underwriters. So we're at 17. Now, here's the thing. It'll probably get to 35, 36, 38 bips soon. The default rate could double. Yeah. And when the default rate doubles, you'll probably see headlines everywhere. You'll probably see
this is the great crash of
the end of the world. It's the end of the world. On Twitter, they'll say, well, the 4 horsemen are on the horizon. The apocalypse is here. Asteroid, everybody, the country's burning down. They'll say because it doubled. But it was so low. It was lower than most countries on Earth. And a lot lower than the U.S. And when it gets to 35 or 38, I'll just shrug, because that was what it was for my entire existence up until very recently. So I know this. I know that increases of mortgage payments typically do not create default. That's just been my lifetime experience.
Change in situation.
Exactly.
Change. Yeah.
When you talk to a chief risk officer of any bank, and you get, you buy them a couple of whiskey sours in the bar at a convention and say, like, what do you really worry about? Some of those, almost all of them drink. I'll just put it out there. Okay. I don't know them personally.
In this
but
industry, you almost have to.
My knowledge of the average banking executive is they've been known to take a drink. Okay. So I'm saying they're drunks. No, but they are normal people who like to have a drink.
Yeah.
Okay. So you pour a few drinks, pour whiskey sours into the chief risk officer and say, in your heart of hearts, what do you worry about with your mortgage book? What is the thing you worry about as a chief risk officer?
Job loss.
They'll say 3 things.
Okay.
They'll say there's 3 things I worry about. Unemployment, and unemployment. That's what I worry about. Oh. Okay. That's all I worry about. That is the ultimate. I might worry about a forest fire burning down the houses. I might worry about, I worry about natural disaster. It's mostly it's all insured, so it's not that big a deal. But unemployment is what I worry about as a chief risk officer. We haven't had any unemployment yet. We've had full employment. We've had great employment numbers. Eventually that will change. And there will be more defaults. But again, when they get up to 35 beeps and everybody starts screaming they're double,
it's just back to the norm.
It's just back to normalcy.
It's like these rates that we have even today, they're not that bad compared. However, the prices of the houses is what, and the size of the mortgage is what.
Absolutely. You always have to say the mortgages are too damn big.
Yeah.
Okay. Now, just a quick follow-up on our last episode. Fixed rates continue up. The fixed rate is just up. Okay. Up and up and up. People who get renewal letters in June and July are not going to see the occasional 4% number. There'd be 4.9, 4.89, 4 point something in front of a term. No, we're back to 5s and 6s again.
Yeah.
That's where we're back.
And do you think that's deterred? Because I don't know, we had a spring market. It got hot there for a bit, but it's cooling down. Like the summer gets a little slow.
It's always slow in summer.
People are away at the cottage or doing their thing.
You're an experienced realtor,
but do you find it slowing quicker?
Well, I've been told it is. I've had a couple of busy real estate lawyers tell us, whoa, the volume of purchase it was running real hot.
And it dropped off a cliff.
End of February, it's been running hot as a pistol. And I don't know if you can say pistol anymore. There's a bunch of trigger words that people aren't supposed to.
Hooker shower last week, so I think we can say pistol. I think we can say pistol.
I guess you're right. It was hot as a pistol. Okay, it was hot as a pistol. And the lawyer said, "Oh no, it's just fallen off. First week of it was last week. He said it. First week of obvious radical reduction.
Yes,
in new sales coming in. Also, if I remember correctly, the gentleman worked for, I think, Redpin or one of the other big tracking services.
Yeah, Redfin or whatever.
Whatever those guys, he said, I can definitely tell you that less activity all of a sudden.
Really? And that's just for straight residential
Straight
purchaser?
residential, yeah.
And that's for personal residence?
Ontario, yeah.
What are we seeing in investment right now?
For the rentals?
Yeah.
Well, here's the truth about, I think, what the truth is about investment property purchase. It's just hard with these rates.
It is.
Even though the rents, it's hard with these rates, it's hard with these prices.
Yeah.
Okay. It is hard with these prices. I mean, like, let's think about a condo that I refer to as the dog crate in the sky.
Correct. Yes.
485 square foot condominium.
It's a walk-in
studio.
closet with a toilet.
Jeez. Okay, that's bad, but you're right. Okay, it's small
and a hot plate. Sometimes some of them don't even have ovens.
No, that's a hotel pool thing. But like, there's some form or fashion of a kitchen there. But like, I call them dog crate in the sky. Mm-hmm. And when I do that on Twitter, there's always at least 2 people reply, I love my condo. I love my tiny condo. You fat fuck. You are putting me in the category of
we have a pool.
You're triggering me. You're triggering me. It's not small. I have great amenities. It's fine. You're just a fat boomer fuck who doesn't. I love my 485. And then there's about another 80 replies that say, yeah, God, that's too small.
Yeah.
Wow, that's small. Wow. So, but that 485 square foot condo, 540, right? In downtown,
in and around
540.
Yeah. Downtown, yeah,
540.
100%.
Okay, 560. We see it all the time.
Plus condo fees.
How do you square that circle on an investor for an investor? Because what kind of another really smart guy who thinks about condos all the time. He talked about it on Twitter. He said, "Look, condos in downtown, pre-construction condos in downtown, they're just the square foot cost is nuts. It's like $2,500 a square foot.
That's a lot.
That's why they're dead. Those pre-cons are dead now in Toronto, but very, very hot in Peel and Hamilton. Hamilton's only sounds crazy to use the word only in front of this, but Hamilton's only 1,800 square foot. Okay, so that's a big difference. It's a 25% difference. Okay, that's an average of buildings, and or maybe they're down at 1,500 and Peel was 1,800. Anyway, bottom line, a lot less, but those numbers don't work. So I would say for investors today, we don't see a ton of activity. There's always somebody who just is awash in cash, right? Somebody is arrived from another country, suitcase full of money, and they
got to put it somewhere.
And there is still investment sales happening, of course.
What do you think the percentages of that in Ontario?
Like
from what's selling, what would you say the percentages is actually still investors? Because during COVID, it was crazy.
It was nuts. I mean, it was 1 in every 3 purchases of residential property was invested. So during 2021, it was 1 in every 3 purchases in Ontario was for investment properties. They're going to rent them. So what is it down to today? I think it's well down to 1 in 5, 1 in 6, or possibly less. Okay. Because I just don't think these numbers make sense to the average investor. Like if you were the average guy who was buying those units and you were buying a house in 2019 for $500,000 less or a semi for $400,000 less, and you could make the math work because the mortgage rate was much better too.
All the rates were much better.
Everything was better.
Because what I don't think the average consumer realizes is that these CMHC insured mortgage rates, you can't get that on an investment property.
No, you cannot.
You cannot achieve these low rates, so they're even higher. Than rates we're talking about.
Some of the low insured rates, CMHC rates we were talking about that were down a month ago. The rates were way down. No, that's not eligible. It's as simple as that. So I don't think unless that guy with the suitcase full of cash is showing up. There's some of those. That still happens. That still happens. But I don't believe that any of the people I talk to, who and the podcasts I watch, where people talk about investors buying rental properties, it's not big.
No,
it's not the way it was.
No.
Not to say that here's a crazy stat I heard last night from I believe it was either Doug Porter or Tim Hudak. Doug Porter's the economist with the Bank of Montreal. Tim Hudak's the head of the RIA, and 17% of all the single family homes, single family detached homes in Ontario are owned by investors.
Yes.
That's a huge change from 25 years ago. Huge.
Well, that number drastically increased, like we said, in 2020, 2021. Yeah. They were just snatched straight up. That's what caused all the madness. You had big changes, a new couple fighting.
Yeah, you had a first-time home buyer.
First-time home buyer, fighting with suitcase money. Who do you think won that bidding war?
Yeah, or even if it's not suitcase money, even if it's someone who is taking a very, very large down payment out of the HELOC they put on a house they bought 10 years ago, where they bought a house for $289,000, or they bought a semi for $289,000. Now it's worth $1 million. It's worth like $860. Whatever. They could put a HELOC on that, just haul all the money out.
No problem.
HELOC rate was super low, back in those very busy times. So, yeah, absolutely. We don't see that as much anymore. There's a lot of end users. We're in this brief hot market that started in February. And that's right across Canada. There are a lot of end users. Yeah. But we'll see. Like these jumps in rates, you're right. It could have been a very, very short selling season. Always slows down in June, like you said. But
it does in June, and August is terrible too. Yeah. July's okay. July picks up a little bit.
July's okay.
Too hot to look at anything.
Yep.
Or so it's too hot to go anywhere. You're looking in the air conditioned house.
There's that. But now it could be the rates. It could be the rates that come into the picture right there.
It's still May. It's still May. It should be still considered spring market, and it's a little slow.
It's cooled. Yeah. It is cooled for sure. It's cooled in Ontario, and from what I'm told, it's cooling in British Columbia as well. Calgary's still, Alberta's still pretty good because those house prices are still substantially less.
Much lower, yeah.
The houses that haven't burnt down. What we heard, and I really feel very, very bad for these people affected by the forest fires. It's just god awful. Yeah. And I've been to some of those towns. Like I actually been to a place like Lake Labiche. Okay, like I've been to those places. I lived in the northern Alberta for a few years, and it's really, really bad. But here's something wild that happened. We put in an application. But 2 applications for purchase mortgages in that northern Alberta area. We were turned down by the mortgage company. That is in the fire zone, they said. You're in the fire zone.
Yeah.
Go find somebody else. Okay, we're not doing it. So
you got to be careful. It's just like Tornado Alley.
Things change. Well, they're still selling houses in Tornado Alley, so
you got to be a little more careful.
I don't know how does that work in a place like Texas, where there's tornadoes in Arkansas and all those.
Insurance must be insane.
No, but how does that work? Like you can't get a mortgage on Tuesday, but we'll check the weather on Thursday and see if you can get a mortgage. Like, I don't know how the hell would that work. I don't know. It's wild. So we'll see whether the tornado's coming or not.
Yeah.
So that's one thing. So I knocked the crap out of that study. I talked about the fact that I don't believe that there is going to be this unmitigated emergency, or everybody would be terrified by their payment increases in 25 and 26. I think it's an overblown statistic. Now, one of the things I wanted to talk about, though, today is that I was at this panel yesterday. I was not on the panel, but I was listening to a bunch of good people on the panel, and there was a discussion of are we going to see the change that a lot of realtors and mortgage brokers are looking for? Are we going to see the change where we will get 30-year amortization for a CMHC mortgage?
Yes.
Okay? And yeah. So because right now, for those people who never got a CMHC mortgage, what that is it comes with an insurance premium. It gives you access to the best rate, and it gives you access to a lower down payment. So you can make as low as 5% down, under $500,000. There's a sliding scale up to $1 million. Well, $999,000. It's capped at $1 million. You can't buy a property over $1 million with the CMHC.
So that's the talk that they want to extend.
That's a cap. There's a hard cap of $1 million, and there's a cap, and there's a contract requirement that it cannot be more than 25 years.
Yes.
Lots of other things are tough. It's very tough on debt ratios. It's very tough. It's pretty tough on credit. But debt ratio is certainly very, very tight with, today with these higher rates, and a stress test, 2% extra.
Yes.
Okay, qualifying rate. So the question came up, is there a chance that we're going to see 30-year AM? Because the idea is that you're going to give a consumer a break, the young first-time home buyer, chance to get 30-year AM makes it a little bit easier.
Manageable payments, yeah.
And there was a question, are we going to see an increase on that $1 million hard cap? Because in Toronto, that might not be enough, right? And Vancouver, definitely not enough. Get it up to 1.25 million. This is something that's been talked about in the mortgage industry for the last 2 or 3 years. Been a lot of talk about it.
Yeah.
I was lucky to be, that question came up with the panel. Panel said whatever they said. But I was lucky that night to be sitting next to senior vice president of one of the mortgage insurers.
Okay.
Who I've known for years. And that person said to me, never going to happen.
No?
Never going to happen. Neither one of those. Never going to happen this year. Never going to happen next year. I won't predict for eternity. Okay. But no. Because obviously the people who actually work at the mortgage insurers, whether it's CMHC or Sagen or Canada Guarantee, they're in communication with the Department of Finance. They're in communication with all the powers that be in that industry constantly. And they would know. And no, the answer is no.
Really?
Those things are not happening.
So
not
wishful thinking then?
Well, it's just, if you're a mortgage broker, you're always asking for it. It's part of the association asks for it. Our little association asks for it. Say, hey, Mr. Politician, no, you should do this, help first-time home buyers. The answer is no. They're not going to do it. They feel it's too much of a demand stimulus. They feel that the idea that they would be running in a country where you can buy quite a nice house in Brandon, Manitoba for $314.
Yeah.
That they don't need to have a $1.25 million support program.
Yeah, in those markets, it would open it up
and it's demand stimulus. Yeah. That's clear. Okay. And the government, I think I won't say they've learned their lesson because the government never learns their lesson. They just, sometimes they start to feel uncomfortable. So I think they feel uncomfortable with the idea that we're going to do these things and 1 million people are going to pop up and say, that's demand stimulus, you sons of bitches. You're just trying to make house prices higher. Yeah. So we're definitely not going to see that. That's not happening.
Now, on a conventional loan that's not insured, is the cap still 30-year AM?
Yeah, we don't.
There was talk about that going to 35.
No, we're not going to see that either.
No.
We're not going to see that either.
So that's being kiboshed too.
That's not something that the bank regulator, OSFI, or the Department of Finance is interested in. They, that brings us to another interesting question. The regulator, the Office of the Superintendent of Financial Institutions. Now, isn't that a long-winded? Like in every other country, they've shortened that name down to something that's more feasible. Okay? Yeah. But no, we're going to call it because who actually uses, there is actually a guy who is the superintendent. There's a guy named Peter Rutledge who is I am the superintendent of the Office of Financial Institutions. Like it's a person. Okay. Like who the hell uses...
Didn't he drink with his brother-in-law in Montreal or something?
You had a drink with his brother-in-law in Montreal.
He was telling me about it. That was weird.
You had a drink with his brother-in-law in Montreal. That's right. So it was at a mortgage meeting, I think, too.
It was. It was.
Right?
It was.
Strange coincidence. But that's an old name, right? Like a superintendent is a crazy word because a superintendent, when I was a kid, was like the head janitor at the school.
I'm thinking of Superintendent Chalmers from The Simpsons.
Yeah, that too, right?
There you go. Right?
That's also, but that's not like a janitor. That's like the superintendent of the schools, right? Yeah. I mean, so a superintendent can be a boss, but it's kind of an old-fashioned name, right? Okay. So anyway, the Office of the Superintendent of Financial Institutions.
That does sound important.
That's not important. It's a hard acronym to roll off your mouth. It's like OFSI, that's what you call it. Anyhow, those guys and gals do a good job, even though I make fun of them sometimes. I don't go after Mr. Rutledge as hard as some people in our industry do. Oh, okay. But because I've listened to him speak a few times. He's obviously a smart guy. That said, they announced about 3 months ago that they were doing a campaign to reach out to all stakeholders in Canada about their ideas for changes in improvements in the mortgage rules in this country. Okay. They're bank regulators. They regulate all federal institutions. And let's face it, the big banks in Canada, they do 86 to 87% of all financial transactions in Canada. Like they're it. There's a lot of companies that do mortgages, but normally the money ultimately comes from one of these big banks.
Yeah.
And they're so dominant in our country. So they regulate, and he also regulates CMHC. Mm-hmm. That's also part of his, and the mortgage insurance companies. Mm-hmm. That's part of his bailiwick. And it's another old-fashioned word, right? There's probably there's 400 millennials just shut the podcast down. What is this guy? He is so fucking old. I mean,
tell us why we're angry.
What the hell is a bailiwick for? Shut this off. My God, it's Jesus. He's older than my dad. So anyway, that's his thing, and they launched into a study of what they should do for this year in mortgage rules. Mm-hmm. And I will tell you, something is going to change. They were pretty oblique about what it was. They talked about in the general way that they felt that they wanted to have more impactful thoughts about debt ratios, but particularly about total debt.
Okay.
What is the total debt, and how is it calculated, and how do we arrive at it? Mm-hmm. What should it be? And I would tell you right now that I feel, and I'm 99% certain this is how it's going to work out, the people to think about this thing are real estate investors.
Definitely.
People who are buying, plan on buying, or are involved in buying rental properties, individual rental properties. Mm-hmm. I'm not talking about a guy who's got an apartment block,
no, that's
suites,
a totally different beast.
Totally different beast. Multifamily, totally different beast, all commercial.
It's still only one mortgage.
It's one mortgage, but it's
6 units.
It's commercial underwriting. Yeah. It's a whole different thing. So it's not about those people. It's about people who start out saying, I want to create a sort of a miniature real estate empire. Mm-hmm. And I want to go out and I want to buy it. Often the phrase that's used is doors. I want to end up with 8 doors. I want to end up with 4 doors. I want to end up with 12 doors, 20 doors. Now, the reason we use the word doors is because often people will buy a single family home, but they may also buy both sides of a semi. They might buy a duplex. They might buy a fourplex, triplex, whatever. Single family apartment in the basement. All that stuff. Yeah. So you have to count doors, because each door is a source of revenue, right? Yeah. Rents come from doors. So that's the phrase that tends to be used. Mm-hmm. So the concept here is that no more residential class mortgages for people who want to have 8, 9, 10, 20 doors. That's over. Wow. That in the end, we'll see that the way they redesign all of the rules, right now, it's become a lot. It used to be hell's a poppin' back 5 years ago. My plan is to have 30 doors. Holy shit. I mean, all residential. I guess some of my wife's name, some of my kids' names, some of my name. Well, okay, great. I hope it worked out. But that looks to be a target for what's going to be happening in either late this summer or the fall. Wow. As soon as that? Oh, yeah. They've been doing the consultations for 3 months now. Wow. At least maybe 3.5. So it's been going on. And at the end of the day, that's where I see the target. That if you want to have all these doors, you better be commercial. Yeah. It better be a corporation. It better be commercial lending, commercial mortgages. It better fit within commercial rules. Okay. The idea that we're going to have somebody who has got residential style mortgages for 12 doors, that's not going to happen anymore. Wow. And that's, I think, ultimately what we're going to see. Now, is that a bad thing? I have to say that, there's two totally different schools of thought on that. Is that investors provide inventory for people to rent. And the other school of thought is, if you hadn't have bought it, then a first-time home buyer could have got it. Exactly. It depends on what side of the argument you're on. What side of the argument you're on. Okay. Yeah. And everyone's entitled to make a living, but people need places to live. People need places to live, which comes back to the infinite, endless, unending problem of supply of houses. Okay. Yeah. That's and let me touch on that. There was essentially the biggest year of house building in Ontario was 2021. There was the most completions accomplished in 2021 of all previous years, which is great. A couple of important points to consider, though. On a per capita basis, like you have to think about how much Ontario grows every year.
Yeah.
Like you have to think about that and how much it has grown. If you go back to the 1970s and early 1980s, mid 1980s, in Ontario, and similar for British Columbia, but certainly in Ontario, Alberta for that matter, but in Ontario, hard numbers, per capita produced 2.5 times the number of new homes than we produced in 2021 when we knocked over 1 million houses.
Wow.
Okay. It was a record, sure. It broke through the million, and it was a record, but on a per capita basis, terrible compared
not
to
even
the 70s.
A dent.
Not even a dent.
Not even a
dent. Not compared to the 70s. Lousy.
Yeah.
Okay. And by the way, it's gotten worse. Yeah, fuck me. There's less homes built completed in 2022. And by the looks of things, there'll be less homes completed than that in 2023. Yeah. And guess what? 1 million folks arrived in Canada in 2022. About 465,000 of them came to Ontario because Quebec doesn't let that many in.
That's
Quebec
true.
only allows about 50 to 60,000 in. And a lot of people came to BC and a lot of people came to Alberta. And Jesus, that's a lot of people. And what if we knock over 1 million again this year in 2023, building less houses?
Yeah.
It's just awful. Like, it's just utterly terrible. Like this. And why? Why don't we do it? People blame NIMBYism. There's a new thing called a banana. You heard this banana acronym? No. Yeah. I talked about NIMBY early, another episode, but there's now banana. It's something about don't build anywhere, anytime, ever. Okay, that obviously those letters don't work. But
I'm trying to spell banana.
Build anyway. Don't build anything ever. Okay, like, don't build any. Don't build it in build it in Sudbury or something, or build it somewhere build it so far away nobody can ever find it. I mean, that's sort of the new concept, is that we don't want building anywhere, which is bad. NIMBY, banana, however you want to put it, bad. Okay. And a couple of other things, terrible. We don't build infrastructure. I had that huge rant last week about not building adequate infrastructure, not getting the roads to places where we need to build whole new subdivisions, not approving the subdivisions, the red tape. A guy sent me a note on Twitter. He said, Ron, I thought Rob Ford had put a program together earlier in the year that they're going to cut the red tape. They're going to cut all the red tape to get houses built.
He mentioned it briefly.
Yeah. It was part of there's going to be an act, and there's going to be legislation. We're going to cut the red tape, okay? Well, apparently, there was red tape to get the scissors. There was too much red tape. The scissors aren't there yet, and the scissors cost like $2 million for the scissors.
And they're not running with the scissors.
The cutting of the tape is not... The cutting of the red tape has got too much red tape to find the scissors. There's no cutting going on.
They can't run with the scissors. Jesus,
it's just ridiculous. The red tape is just as bad as ever. The infrastructure is not going through. The houses are not getting built. The green belt approvals, which may be theoretically coming to be, and the yellow belt approvals to get more houses built. Well, where are they? Okay, I haven't seen any new subdivisions strike up.
And when they do build, it's a 400 square foot condo.
It's a 4,000 square foot monster home for $2 million.
We need just a nice 3-bedroom, 2-bath family home.
Please, yes, please.
Family homes.
Yes, please. But so that's a big deal to me.
It is.
That's a big deal. We keep talking about adding supply. We keep begging for supply. Politicians keep promising supply. And there's no supply.
Nope.
If there's less homes built in Ontario in 2023 than 2021, the only term you can apply to that is abject failure. Fucking failure if that happens. And that's where we're headed, by the way. That's exactly where we're headed.
It is rough.
Now, that brings us to our favorite segment.
What the actual fuck?
That's it. What the actual fuck? Here's my rant of this week is that, the mortgage business It's not simple. But the mortgage product is simple. If you think about it, the mortgage product is simple. A mortgage is simple. It's a loan.
Yeah.
That's all it is. It's a loan. There's an interest rate. There's a payment. You make your payments. You get your money.
Don't take your house.
Lawyer gets the money. You buy your house. You refinance your whatever you're doing. You get your money. There's the loan. Payments in the contract. You make the payments. Life is blissful. All the mortgage product says is it's a loan. Here's the interest rate. Here's your payment. Make sure you have property tax. Make sure you pay your property tax. Make sure you have insurance on your house.
Yeah.
That's it. That's not complicated, is it?
No, it's pretty simple.
So when you're getting a mortgage, if you're the borrower, you are concerned about getting the best possible rate because why wouldn't you? Like, seriously, what are your rates? Well, over here, we've got Bank X is 4.45 for a 3-year and Bank Y over here is 506. Do you think the 506 is better? What do you think? No,
I'm probably going to take the X because at the end of the day, the product is still basically the same.
The product's the same. There's what do you have to worry about? Get the best rate. I'll say that about 10,000 times until I'm dead on this podcast. Shop hard for the best rate, number one. Number two, the basic contract provisions, which are important. Read up on what the penalty is if you break it. Read that. Make sure you understand it thoroughly. Make sure you understand your prepayment. Can you put in a lump sum payment? How much? 20%, 15%. Can you make additional payments every month? Can you make it? Can you increase your payment?
Yeah.
Read those parts. The rest of it is all the same. Like every single bank is the same for the rest of it. Just 2 things to think about, 2 things to read. Break penalties and prepayment and the interest rate.
Yeah.
Product's simple. Now, I'll fully grant you that the application part can be hard.
Sure.
Like, sometimes the people don't fit the mortgage profile that they want for the house they want to buy. They can't get enough mortgage. So the application part, yes, you need great, competent people on the application side.
Yes.
Good, strong people. Get you processed properly. Although the majority of people don't have trouble, want a mortgage, don't have trouble getting a mortgage. But you want these strong application people. That's the complex part. That's where you want a professional, whether it's a professional bank rep, great mortgage broker, whichever the case may be. That's the tougher part.
Yes.
But here's what my rant is. All of you mortgage brokers who want to say that, hey, Mr. Public, hey, Mrs. Public, you will never, ever understand this. Without my guidance, without me being the Sherpa guide on the mountain of mortgages, you will never figure this out. You need me. Like, fuck you all, okay? You don't. That's not true. It's just not true. Don't make it out that you have some special ability, magical ability. By the way, there's a guy who does a podcast that says, for free, because that's really all it's worth.
Okay.
Sorry, it's not really a podcast. He does a series of broadcasts, but he's on YouTube. But anyway, he says, for free, I will send you my book of mortgage secrets.
Oh, the secrets.
The secrets, okay?
Yes.
The secrets. Like, I gotta let me say this, folks. If anybody tells you they have a book of secrets about mortgages or, I don't know, sex toys or real estate or the secrets of the pyramids or there's no goddamn secrets. It's bullshit. The secret is, hey, buy my free book and get mortgages from me, or don't buy me. You can't buy your free book. But if you're telling if you say something is a secret, it's just bullshit. That is bullshit. The people who tell you, oh, you need a guide, you will never figure this mortgage stuff out yourself. That is bullshit. The people who have the book of secrets, that is utter bullshit. Okay. And the crazy part is, you don't need to deal in bullshit to be a successful mortgage broker. No. It is not required in any way. There's tons of great professionals. There's tons of great bank specialists who are very knowledgeable, very efficient, very good at their job. And don't portray that they are the only guide that will be able to save you up the mountain, the Himalayas of mortgages. There's a book of secrets here. Let me pass it to you under the table.
We need a copy of the book. We should read some excerpts in a couple of weeks.
No, look, I'm not that mad at the guy. I'm not going to.
We can blank it out.
It just drives me nuts that there's always there's a certain podcast that come out, and if you join my coaching group today, I will be able to teach you the key unknown strategies to get the mortgages you need. Come off it. Jesus Christ. Just do the work. That's it. Just do the work. Quit peddling secrets. Quit telling people that you need only through me will you be able to get your mortgage approved. I am the guide. You will never figure it out on your own. It'd be hopeless. Everybody don't do that shit. It's not necessary. I actually knew a guy once. The guy's still around. I know him. I know him. He came out with a book. It didn't call it a book of secrets.
Okay.
But he called it a bestseller. He called himself best-selling author. Okay. I am the best-selling author. Here,
are you allowed to just say that? Isn't there
Sure, because on Amazon, a best-selling author is 1,000 copies, and you order it yourself, okay? Like you buy the 1,000 copies, you are now a best-selling author on Amazon.
Perfect.
Sweet Jesus, okay? Yes, a best-selling author, Mr. Stone Nuts, okay? I am it. I am the best. You want to deal with me? I am a best-selling author. Oh, perfect. My sweet Jesus. No, you are not. You are not. You are not Stephen King, goddammit, okay? You're not Stephen King. Screw yourself, okay? You're not even, no, you're not, okay? Don't, please. All I'm asking for you, all you mortgage brokers out there, and there's so many good ones, and there's so many good bankrupts who are just normal people doing great jobs, men and women who do terrific work day in and day out for their customers, their clients. None of them go through this best-selling author, book of secrets, Sherpa guide on the Everest of fucking mortgages. None of them do it, okay? Yeah. None of them do it. They just do their job. So all the rest of you, best-selling authors, book of secrets, I don't know, like, is there a secret way to open the book? Like,
I don't know. Please. I'm very intrigued now. I think I need to order
you need to order this. You need to get this book.
I want to know. I want to know the secret.
All you relatively small group of mortgage brokers who tell people, you will never figure out this mortgage without me. Like, just stop. Stop, all of you. Stop. It's not necessary. It's stupid. And it degrades the profession. And that's my rant for all you folks out there with the Book of Secrets.
What the actual fuck?
All right, folks. Thanks for tuning in again this week. Hit those like buttons or
subscribe
buttons,
like,
or whatever goddamn positive
share,
button there is. I mean,
smiley face.
All of it. Just hit it all. Grow the community. We appreciate it. And we'll see you next week. Bye.
If you like the pod, well, don't just sit there. Go to YouTube, Apple, Spotify, and all the other ones and like the pod. And don't forget to subscribe so we can keep being angry at mortgages and swearing about mortgages. Angry Mortgage could use your support.